Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 29th of January. I'm Daniel Lam, your host for the podcast. On this Thursday early hours, East Asian time, we will have the first FOMC rate decision of the year. While virtually all forecasters are expecting no change on the rates front this time around, the narrative from Powell would be very much watched after, especially when the US 10-year government bond yield has been backing up year to date. Currently, the positioning in US 10-year Treasury bond is around neutral. But do note that only a fraction of the late 2023 pivot flows have been unwound in the first 3 weeks of this year. And that's despite some stronger than expected macro releases and also rising rates. Fast money investors are still more bullish than they have been since the start of the rate hiking cycle in early 2022. On the other hand, in the absence of a QE-fueled easing cycle, it is tough to see the positioning getting too stretched to the bullish end at this stage. Now you would ask, how about the other side? i.e., what would it take for investors to take a bearish bond position? Well, it would take some hawkish language from the Fed at the press conference following the FOMC. Now, one major potential hawkish development would be for Powell to rule out altogether a March 2024 rate cut. But key data, such as the non-farm payroll and the CPI, is yet to come. So he's probably more likely to be keeping his options open. Now, nonetheless, there are reasons to support taking a more cautious view going into this FOMC. Well, technically, 4.25 to 4.3% in the US 10-year government bond yield seems to be a key sell trigger for CTAs, i.e. the trend-following strategies that would be activating short US 10-year Treasury bond positions if yields do break higher above that level. Moreover, from fund flow data over the past 5 to 6 weeks, we have seen fund inflow into US equities at the expense of some other regions. Globally, there has been reasonable inflow into the more defensive sectors, such as healthcare and staples. So, taking all these into account, it would be prudent for investors to look to partly lock in profit in US equities at the current levels, and look to do either adding back to US equities if S&P 500 pulls back to 4550 and 4400 levels. Or they may consider rotating now into sectors such as healthcare, where we are overweight due to their defensive earnings, as part of our barbell approach. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.